It's no secret that the stock market is a volatile place. The ups and downs can be exciting for some, but they can also be nerve-wracking if you're not prepared. One way to make money during these times is by selling options. When options volatility is high, you can sell options at a higher price than you would when volatility is low. In this video, we will discuss how to make money during market volatility and how to protect yourself from downside risk. We'll discuss what is market volatility, selling stock options in high volatility, and high volatility option trading rules. Real quick guys, please hit the like and subscribe buttons below, as well as comment and let me know your thoughts on this video. Also be sure and grab the free Simplified Options Strategies Trading Guide. I'll put a link down below. It covers the different option strategies, setups, how and when to put them on, max profit, and trade management. It's a great guide to have by your side when trading options. So let's get started. What is market volatility? Volatility is a measure of how much the price of a security like a stock, ETF, or commodity fluctuates over time. It's often used as a gauge of risk. The higher the volatility, the greater the risk. Volatility can be caused by many factors, including economic news, earnings announcements, and global events. For example, the COVID-19 pandemic caused high volatility in the stock market. There are two types of volatility: historical and implied. Historical volatility looks at past price movements to calculate how much the security has fluctuated. Implied volatility looks at the market's expectations for future price movements. It's based on the price of the options contracts for the security. High volatility means that a security's price is moving up and down rapidly. It's considered riskier than low volatility securities. As options sellers, high volatility is our friend. One way to make money during market volatility is by selling options. When you sell an option, you're giving someone the right to buy a security at a certain price. In exchange for this right, they pay you a premium. If the price of the security doesn't move as much as the buyer of the option expects, they may lose money. That's where you come in. When volatility is high, you can sell options at a higher price than you would when volatility is low. However, if the price of the security moves more than the buyer of the option expects, they make money and you lose money on the contract. You may also be assigned the stock or forced to sell at a loss. That's why it's important to have a sound options trading strategy before selling options during periods of high volatility. We typically like to sell option premium versus buying it. Selling premium allows us to collect premium month after month. By doing this, we're acting as the insurance company or the casino versus someone who is buying premium. Buyers of options are playing the role of the gambler, and keep in mind that the house typically wins in the end. A few options trading strategies that can be used during periods of high volatility are selling puts, calls, and strangles. When we have winners, we want to close them and take them off the table. If we wait too long, it can be hard to manage the risk and we could end up scratching a winner. We should look to close out winners at 50 to 75% profit. However, we should take into account time. We like to put on trades with 30 to 60 days to expiration. If we have a 30-35% winner in just a few days, we should consider booking the trade and taking it off right away. Not all of our trades are going to be winners. Some will be losers. The key is to accept them and move on without having them bring down your whole portfolio. If we have a 200% loser, then I'll go ahead and close it out and just move on. I don't like to throw more money at a bad trade. It's just a rule that I stick by. For any other loser, I do a quick evaluation at about the 21 days to expiration mark. As long as the volatility is still fairly high and my thinking on the trade hasn't changed, I look to roll out in time to the same price. By rolling out to a new monthly cycle, you're giving yourself more time for the price of the underlying security to move in your favor. You can also normally collect more premium. And if the price doesn't move in your favor, you still have the option to roll out again. Very rarely does it take more than 2 or 3 rolls to break even and become profitable. The key is to be able to track this. Here's an example of several successful rolls of Twitter on the Tastyworks trade platform. I'll put a link down below and you can get a free offer when you open an account. It's the best options trading platform out there right now. You can see where we made over $3,000 this year on Twitter by closing and rolling to the next monthly option cycles. The key to successful options trading is to have a sound strategy and stick to it. By following a few simple rules, you can make money during periods of high volatility. By closing out winners early and rolling at 15 to 21 days to expiration, you can collect additional premiums and give yourself more time for the market to move in your direction to be profitable. All right, guys, please hit the like and subscribe buttons below, as well as comment and let me know if you have any questions about trading options. Also, be sure and grab the free Simplified Option Strategies Trading Guide. I'll put a link down below. It covers different option strategies, setups, how and when to put them on, max profit, and trade management. Thanks for watching, and see you in the next one.